Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. Before we dive in, as usual, nothing here is investing advice. Do your own due diligence. And today's guest is the founder and editor of the TF Metals Report, a highly successful newsletter service and website that's been around for 12 years now, which is amazing. And we welcome back Mr. Craig Hemke, actually the most popular guest ever on the program. So let's try to trap lightning in a bottle twice here.
Well, clearly that's due to my rugged good looks. I don't think I thought about that. That's funny. It's great to be on, Jesse. I've been laughing a lot recently because we just had that 12-year anniversary, and the line I usually use is precious metal years are kind of like dog years, in that I think it's about you age 3 years for every 1 year that you follow the precious metals. It could be four. Um, because man, they'll do it to you. But we keep slugging on, and man, this next year promised to be a doozy too.
Interesting. Now, I want to talk about kind of a 2022 year in review from your perspective before we kind of forecast and look ahead. What do you think have been some of the main events and developments in financial markets and the economy, starting with the negative? And there's so much bad news, obviously, so it's
Yeah.
kind of hard to pinpoint. But from your perspective, what really sucked in 2022?
Well, there are so many moving parts that one of the things I said about 22 was that the only thing predictable is how unpredictable and volatile it was going to be, and that of course turned out to be right. Where I failed this year is I had anticipated that the pressure would build on the Fed quicker than it has. And I think part of that is due the delay in the Fed pausing and pivoting is not the fact, at the one point the Dow or the S&P was down 25%, or that the 10-year note got to almost 4.5. It was just that was actually that ramp up was delayed. That Fed policy ramp up was delayed by the war in Ukraine that nobody saw coming. So that kind of kept them from tightening faster because they were slow to react to that. Inflation got even hotter. And now they're trying to play catch up on the back end. And so a lot of what I thought would happen in the back half of this year is probably more slated for the back half of next year, or maybe the back 2/3. And again, I feel very confident, the Fed eventually has to stop hiking and pivot and will move to cut, though a lot of folks are even saying, oh, next year, they're not even going to cut next year. Yeah, well, yeah, just wait. But it has been this shift in the calendar due to all these unforeseen events, that you couldn't really predict. And I think there's a lot of that that's going to go on for 2023 too. Folks are going to read a lot of predictions. It's December. A lot of predictions about, so-and-so's chief macro strategist says this and that. And the chief macro strategist may be right. But what you can't control is the timing of it all. And that's been the biggest challenge this year. That'll probably be the biggest challenge for next year too.
So what about anything positive that you saw in the markets or in the overall economy, or anything that has you excited looking ahead?
I think no, I shouldn't say the biggest. The first thing that comes to mind, let's put it that way, is the general tightness in industrial commodities, industrial metals. That's a trend that's been going on now for 5 or 6 years. Folks may have seen some of the charts, if you're on Twitter or, interested in the sector of just declining vault inventory levels globally of all of the industrial metals, lead, zinc, copper, nickel, aluminum, and silver. And those dwindling physical supplies are really going to be a key thing in 2023 because the pricing scheme for all of these metals is still based off of the trading of the futures contracts. And excuse me while I itch my nose, this seems to happen a lot this time of year. The futures contracts have to have some physical delivery as well. And the whole thing is kind of a house of cards in a way. And as physical stockpiles dwindle, it really puts a stress on the system. Another one is palladium. We've been watching palladium for 3 or 4 years now, and I just saw something last week. Some warnings out of some of the bigger palladium producers that since the LME has cut out Russian palladium products, or at least maybe they're pending to do that, or they have, that will really throw a wrench into the global palladium markets. Well, again, it just takes one, and investors or users of those metals will sit back and go, whoa, wait a second. And all of a sudden you get this kind of rush in all those metals. And so, and that's another thing that has developed and continued this year that at least has the potential to really disrupt things next year.
I want to get your thoughts on the new green economy and this whole movement that's occurring, because I've heard, we hear out there that a lot of the demand for some of these base metals is
Yeah.
pushed on by all of this push for renewables, push for carbon
Mm-hmm.
neutrality. Do you see that as a sustainable long-term thing, that particular area of demand? Because a lot of these politicians who are implementing these policies don't really understand the amount of minerals actually needed to reach their end goals. They seem completely disconnected from physics and from reality in many ways. And very
Right.
often the same people pushing for the new green economy hate mining. So they don't want to turn
Right.
around and mine for these minerals. So do you see, that continuing? Do you see the pendulum swinging the other way and the whole thing falling apart? Or do you think that's going to remain a strong demand driver for base metals and things like silver?
Yeah. I mean, that's a big challenge. Like, we hadn't even mentioned lithium, but
Right.
I think that's one of the things you're referring to, Jesse, is the amount of energy and environmental disruption, I guess would be a right word, involved in lithium mining. So until they come up with a different metal to be used in batteries for all these electric vehicles and the like, that's going to be a huge problem. And again, you can take that down to copper, silver, some of the other metals that are involved in electricity generation and movement and that sort of thing. Hey, great, let's have solar panels everywhere, but how much silver is that gonna take? And let's have more electric vehicles and batteries, but how much copper is that going to take? And with these declining physical stockpiles, the only way you can replenish that is to have more mining, right? Well, at these price levels, maybe that's not a sustainable proposition either. One of the what is it? Rick Rule, who always used to say the key to low prices is low prices, right? Or low inventories is low prices. You got to get more mining done. You got to have higher price. You got to have incentive to have people do more mining. So that's a multi-year conundrum, but certainly something that hangs out there for the years to come in terms of commodities in general and their pricing.
I'd like to get your thoughts on gold as well. Q3 of this year was a record high for central bank gold purchases, bringing
Yeah.
global central bank gold reserves back to levels not seen since the 1970s. So firstly, why do you think this is occurring? And secondly, do you think this central bank gold buying trend will continue moving forward?
Yeah, and this has been going on, as you said, for years, Jesse. What I think was it 19 or 20 had, the most central bank gold purchases since 1968 or 69. And now we're blowing that out this year. I've often referenced it as, hey, look, if you believe that these central bankers are smart, and I think that's kind of a dubious argument, but I think they are, where they are diversifying out of their dollar reserves into, at least some, diversification into sound money. Maybe that's what you ought to do too. Because that's what's happening here. They're converting dollar reserves into gold. Is that in preparation for some pricing event, some valuation event in gold? Maybe. Is it in preparation for an eventual turn back to some anchor to the monetary system? Probably. But what's hard to assess is the time frame of that kind of stuff. I mean, I'm talking about this stuff for 10 years now, and it hasn't happened yet. But it does impact the market eventually. At present, again, with this derivative pricing structure that's gone on since 1975, the price you see is, what crawls across your screen, from trading forward contracts and futures contracts. And so it's kind of the supply and the demand of those more so than the supply and the demand of the physical gold that drives the price. But there has to be some physical connection to that derived price, that you get from trading futures. And that's where the things are getting stretched. We'll watch that as we go into 2023. Maybe it's more more of an interesting story in terms of silver, since the Silver Institute just came out and said there might be a 200 million ounce supply deficit for silver next year. But it certainly pertains to gold. And the more gold that's taken off of exchanges, whether that's, LBMA vaults in London or COMEX or Shanghai or whatever, and moved out of their hands and into private hands, whether that's at the central bank level or at the institutional level or the individual level, the more that system gets stretched. And so that's a trend. Again, we've been monitoring for years. Will it break in 2023? I don't know, but it continues to exacerbate the stress in that system, in that pricing system.
So we've seen a bit of a rally in both gold and silver prices recently. Everyone's looking for a return to previous all-time highs. I mean, gold hit its all-time high not too long ago. We talked a lot about manipulation of the precious metals in our last interview. So I'm wondering, are we seeing more tamping down of the price through paper contracts when we do get kind of this attempt at true price discovery? Do you think that is occurring? And do you think the manipulation might be broken sooner rather than later here? Obviously, it's a timing issue. We discussed this before. You never know when. But are you seeing any signs that system is becoming more fragile?
I've been thinking of late as to whether some of those actors have left the stage. It used to be when I first got involved in this in 2008 and 9 and then through 2012 and into 15 and 16, you'd just be sailing along and in the middle of the day, the bottom would just drop out. Or at the most odd times, whether a Sunday evening or like a Tuesday at 10 o'clock Eastern, something like that, all of a sudden, there'd just be this rush of volume, compared to any other times of day. And then boom, price just falls like $20 in gold, and 60 cents in silver. That doesn't happen anymore, or at least infrequently, or at least less frequently than it did. And so I wonder if a couple of things have actually had maybe a greater impact, or maybe the impact that we'd hope. One being the Basel III changes, trying to force these banks out of that paper game into more physical. But then also those convictions at JP Morgan and the almost $1 billion fines that they had to pay. I mean, when you take the former head of precious metals trading for JP Morgan and you convict him, and I don't know if he's been sentenced yet, but Michael Nowak is still awaiting. I mean, he may end up doing some time in the hole for overseeing that operation. Put those things in there, we might be seeing finally banks stepping away from that. I mean, I just saw a news article record this morning about HSBC had decided to get out of the industrial metal business altogether a couple of years ago. Now they just petitioned and quit the LME this month here in December. So the manipulation part of it, and again, much of that I always felt was just done by bank trading desks for profit because they could. That may be easing. In this turnaround this fall, silver has led the metals and the miners down as the dollar rallied. But silver also bottomed first. Silver bottomed back on the 1st of September, where gold really had this kind of floor that it put in October and November instead. And so silver, where it let everything down, has been leading things back up, gold and the miners. And that may very well continue. The part of this bottoming process in silver is we were able to monitor the hedge funds that trade silver futures get extremely short 4 times in the last 90 days. In doing so, they left what are called the swap dealers on that category in the Commitment of Trades report. And what are swaps? Those are futures and options. Those are derivatives. And who deals those? The banks. Okay, so the banks were getting long while these hedge funds were getting short. Well, that's just an inverse of what we've always seen in the past, where the banks are short and the speculators are long, and then the price drops out and they get ruined and the banks profit. Well, hey, lo and behold, 4 times in the last 90 days, those speculators have been ruined by spikes to the upside and short squeezes. So there are some, these kind of fundamental kind of ancillary changes that are kind of taking place in the structure of how this works. Now, whether that'll continue, we'll see. If price rallies as I expect next year and into 24, how actively will the banks supply the short positions that the speculators take long. We'll just have to see. If they don't, that could exacerbate the moves to the upside. But I do sense less intervention on a grand scale than what we saw all the way, I don't know, up until a few years ago. So it'll be interesting to see if that continues.
Yeah, very interesting. Certainly something to keep an eye on. So I want to get your take on a statement in an article from Routers, however you pronounce that. And it stated the Bank for International Settlements has warned that pension funds and other non-bank financial firms now have more than 80 trillion of hidden off-balance sheet dollar debt in the
Right.
form of FX swaps. Can you break down what that means for us in layman's terms and how this could affect the global economy?
Well, this is one of those things I mentioned earlier about events that are out there, whether geopolitical or otherwise, that can totally throw off the timing of your forecast. We might think, well, the Fed's going to start printing again and start cutting rates and the stock market will go back up, and it very likely will. But what if in the intervening time there's some kind of breakage in just something like this? $80 trillion of off balance sheet dollar denominated derivatives is a lot. Now, the conventional wisdom is, yeah, but that's a problem. It just rolls over, from, over and it's no big problem. Okay, yeah, as long as that continues to happen. But what if a trillion or $2 trillion worth runs into some liquidity roadblock? And what are you going to do? There's no dollars around for that. And so you could very easily get what we were seeing earlier this year, where the stock market falls off sharply and the dollar rallies sharply. And then what does that do to everything? So, and that's just this one little segment. And this is one little thing that Reuters was pointing out, this $80 trillion of this particular, these things that are off balance sheet. Ultimately, that's a function of what the central banks have done in artificially driving interest rates to zero and all this free cash over the last decade. You remember, Jesse, what was it, about 2 months ago now, you had almost a complete blow up meltdown of the British bond market, the gilt market. Remember that whole thing?
Yeah.
I'm sure people listening to us will recall. And that was mainly due to a similar deal where these hedge funds in England had so over-levered themselves that when their gilt market, their bond market moved against them, it drove this massive liquidity squeeze, margin squeeze. So, and what had happened there? It's like when you run a hedge fund, or any kind, insurance company, whatever, you have these actuarial tables that you follow, and you try to hit certain yield or total return numbers to make your fund actually work, to be able to pay out, to your retirees. Well, if you're shooting for 7, 8, 9% a year for your goal that you have to hit to grow the size of your fund, and you traditionally try to do this in, riskless or low risk investments, and those low risk investments are only yielding 1.5%, 2% because of these central bank policies, well, what are you going to do? So you lever that stuff. You buy, what's the easiest way to look at it? $100 million worth of British gilts, English gilts, and then you take your $100 million and you use them as collateral to buy another $90 million. And then you take that $90 million in gilts and you use those as collateral to buy another $81 million, right? So all of a sudden you've got this huge levered portfolio, and then the price of your bonds goes down as interest rates go up, and the whole thing, okay? That just happened. And it forced the Bank of England to step in and provide all this new liquidity and everything else to keep a total breakdown. Okay, so since we know that can happen, when you see these articles from Reuters about this 80 trillion in notional derivatives that are held off balance sheet, it's the same thing, kinda. Okay, so who knows if that sort of thing can or will have an impact. I mean, all it takes is one domino to fall on the next, and the whole daisy chain starts to unravel. Like, I'm using all these metaphors: dominoes, daisy chains, a sweater that you pull at, whatever. But that's definitely, that risk is inherent in this system. And these risks just start coming at the system from all these different ways. as the Fed is trying and the other central banks are trying to unwind this thing that they've created. And so you just don't know what might be, the next crisis. But that certainly is something that should be on everyone's radar.
So let's pivot to central bank digital currencies. We touched on this in the last interview, but there's been some recent developments, so I think it's worth touching on again. And that is that there are central banks now who are openly stating they are going to launch tests of digital currency. So what are your thoughts on these test runs? Does this kind of go part and parcel with maybe resetting the financial system, all of this off-balance sheet dollar debt, can they make that go away somehow with a switch to CBDCs? And do you think that's where they're going? And also, how easy or difficult do you think it will be to implement these currencies?
Well, to me at least, I think what they're trying to do is go around the legislative bodies to which they should be beholden. It's like you go back to 2008 and TARP, right? All these U.S. banks are dying. And I remember the day we were watching it happen one after the other, and there was nothing going on. Then the day that suddenly they came for Goldman Sachs, oh boy, now we got to have TARP, right? And what was that? That was to get Congress to pass this $700 billion thing, and then the Fed could step in legally and fill that hole, right? Even currently, any spending that takes place has to be done at least in the U.S., by the U.S. Congress, and then the Fed steps in and prints the cash, whether it's, all of the programs after COVID, and everything else. What a CBDC will do is allow the central banks to circumvent that and just go either straight into your bank account, Jesse, or straight into the JP Morgan general account, whatever it is. Okay. That's one thing. Should be very inflationary, right? But it's a measure of control. And that's the other part that you don't want to lose sight of here. On my side, we've been talking about what's loosely been called the war on cash for a decade, right? This idea, what do you need cash for, right? It's just a burden. $100 bills, they're only used by bookies and drug dealers and stuff like that, and all this illicit stuff. So why don't you get rid of it? And instead, you'll just have, these digits, whether it's on a card or whatever. Sounds good. Sounds convenient, right? It also sounds very cancelable. You're already seeing all this social credit score crap in China, right? And you can't even leave your house unless they tell you can. You're seeing now, God, I saw a story this week about some town in England where they're going to lock you down to help the climate. What the heck? Well, how about this? We don't like your social credit score. We don't like what you've been saying in social media and stuff. So we're going to freeze your digital assets at the bank because there's no cash anymore. Well, that sounds far-fetched, doesn't it? Until you remember what they did to the people that protested with the Canadian truckers last winter. So this is all, it's a way for the central banks to subvert, legislative oversight and push currency, if you will, out directly to where it's needed to fill holes or whatever. But it's a direct assault on your personal sovereignty and freedom. And man, people better be paying close attention and try to fight this off as much as they can.
Yeah, I want to go a bit deeper down that rabbit hole with you because I know you're a proponent of personal freedom, personal sovereignty. You post a lot about it on Twitter. These common sense concepts that seem to be somehow totally lost in parts of the world today. And it looks, a part of the original agenda does seem to have fallen apart in many countries. I can tell you in Croatia, where I'm at, the whole Balkan region, people do not put up with government intervention for long, and they will take to the streets and protest. They will riot. As it stands in Croatia, they dropped all sorts of restrictions, and now nobody even talks about it anymore. But back home in Canada, it's all you hear on the news to this day. Get your third shot, fourth shot, do this, do that. It's completely insane. And then you have people literally cheering this on, like citizens who are saying, we must do this. And as you mentioned, that was the Oxfordshire City Council in the UK passing this climate lockdown trial that's to begin in 2024, where you're limited to your own zone, and then you're allowed to travel outside of it for a certain amount of kilometers per year or something insane like this. Now, do you think this is going to spread? You were talking about seizing bank accounts in Canada. Do you think this kind of authoritarian movement will spread in the countries in which the citizens are embracing it? And is this kind of part of the package with central bank digital currencies to both restrict your movement, restrict you financially, and therefore have absolute complete control over citizens?
I I have no doubt that that's all part of the process. But then you ask yourself, even on a small scale, this Oxfordshire, well, why the hell get the hell out of there? I mean, if they're going to do that in 2024, then friggin' move. Go someplace where that's not going to be the case. Um, so there's still those, that potential, but I have no doubt that that's the direction they're trying to drive everybody into this control. "Oh, we'll make you very happy. Just be quiet and do what we say, and you can live this happy life." We have to fight against that. I mean, that is not human nature. That is not, uh, those are the inalienable rights given to us by our creator that we have to try to fight for. Um, that living in freedom is not the typical human standard over the millennia, right? This notion of inalienable rights and given, provided to them and natural by your creator and natural law and all this stuff. This is not the norm for human existence. What's normal are kingdoms and serfdoms and fiefdoms and feudalism and all that stuff. So, but we think, because this is what we've known since we were born and for the last, whatever, couple hundred years, that's the way it's always going to be. But that's not the case. And boy, it is definitely incumbent upon everyone to fight back against that sort of thing, because if they, as we've seen, if you give these bureaucrats, technocrats, whatever, tyrants power, they don't give it back, at least not easily.
Yeah, absolutely. And it's definitely important to fight back. It's important to get your hands on sound money, I think, in the form of gold and silver bullion, so you can kind of have money outside of the system, so you can avoid these
Right.
things like getting your bank account frozen and the central bank digital currencies and all that. So let's finish with your forecast for 2023. What are the main themes and catalysts you see unfolding next year? And give us your take, bullish or bearish, firstly on the broader markets, and secondly on precious metals.
I write, and I think you know this, Jesse. I've gotten in the habit for the last 6 or 7 years of writing an annual forecast every January. Just if anything, it's a good exercise for me to kind of take stock of what has happened and then to look ahead. It's very unfun. I can tell you that, because on years where done a good job, like 19 or 20. All you get is, well, anybody could have seen that coming. You're nothing special. And then in years like this year where it didn't work out, I mean, I thought we'd be rallying into year end, and we are, but I thought the lows would come like in May or June, and then we'd rally back toward 2000 by the end of the year or even past. And like I said, that's all been delayed. And now all I get is, trolls telling me what an idiot I am. So it's not a very rewarding thing to do, but I do it anyway. And so as we get into December, I start to kind of collect ideas and screenshot things, as reminders, so I don't forget about some of the fundamental stuff I've noticed. And the idea is beginning to crystallize in my brain, that this upcoming year will be a lot like 2010 and 2019. Now, again, if the war in Ukraine goes crazy and all of a sudden for example, that big nuclear power plant, wherever that is in Ukraine, suddenly has a meltdown and, God knows what could happen, right? War in Korea. I mean, all these, so you try to look at this from a macro perspective and say, okay, on a predictable level playing field, here's what I think is going to happen. In 2010, we were coming off of the first QE program that changed everything. The trend line in the S&P goes back to March 2009, okay? That was a paradigm shifting event. But as 2010 began, you were being told, everybody was being told that was a one-off, Jesse. They're never going to do QE again. It was just done to, help the bank get out of the financial crisis. And through the first half of 2010, all the way into the fall, gold and silver really didn't do much. But with QE2, which suddenly appeared in November of 2010, bang, silver goes from 18 to 48 in about 6 months. Silver, gold soars and all that stuff because everybody figured out the Fed was full of crap. So fast forward, we go through all these next intervening years where everybody's talking, oh yeah, the Fed's going to pull down the balance sheet, all this kind of stuff. We get to 2018 after 6 or 7 years of wandering in the desert. And even though interest rates had spiked to 3.25 on the 10-year and the S&P had crashed by 20%, as we entered 19, there were still all these 8-figure Wall Street economists like Jan Hatzius at Goldman Sachs saying that the 10-year note was going to go to 5% in 2019 and the Fed was going to keep hiking. Well, instead, the Fed had paused and begun to pivot in December of 18. It took about 6 months before they actually started cutting. The first half of 19 was pretty quiet for the precious metals, kind of chopping sideways. And then when they started cutting in June, from June to September, gold went from like 1280 to 1580, about 25%. Silver took off, all that kind of stuff. And we know what happened in 2020. It was all, the printer was going again. All right, so now here we sit, the end of 2022. And there's still all these forecasts, all these, Jan Hatzius is out there again, talking about 5 and 6% on the 10-year note, and Powell's trying to tell you, oh, I don't see any rate cuts coming at all in 2023. Just like a year ago, he didn't even see any rate hikes until 2023. The recession that's coming is going to be sharp. The Fed is going to have to pivot and start cutting next year. If we follow kind of the same loose time frame, it'll be in the summertime. So gold and silver may kind of, now that they're back in their range, may just kind of bounce around between 20 to 25 or something for silver, and gold between 1,700 and 1,800, that kind of thing. But man, when they start cutting, and they will, man, that's when everybody, the curtains pulled back and everybody realized how full of crap these guys are. And then up we go again. Then the only question, I'm 100% convinced of that. The only question is, will the overall market, the institutional investors, the hedge funds and the like, buy with the Fed selling again by 2024 when they start talking about hiking again? Because if they don't, then we get into this late 70s kind of period, where things just keep going up. And that's certainly a possibility. So there's a long answer to a short question, Jesse, but I titled my 2019 forecast. I called it 2010 plus 9, in that 19 was going to be like 2010. A working title for next year's forecast might be 2010 plus 9 plus 4, something like that, in that 23 is going to look a lot like those years.
Very interesting. Looking forward to seeing how that all turns out. And thank you so much for joining us today. For those who want to hear more from you, could you let us know about the TF Metals report and anywhere else you'd like to direct people online?
Well, it's right there. I got my start actually at Zero Hedge, which has now grown into the 15th busiest news site on the planet, and just a cash cow for the people that created it. If you're not reading that site, you got to read that almost every day, because there's no place else that'll tell you what's really going on. Now, you can't say that about everything they publish, but man, if you're just getting your financial news from Lester Holt, at 6:30 on NBC, or from Yahoo Finance, you might as well just be, walking around, with your head up your patootie. You're going to be caught totally flat-footed by what's happening. So start there. But my site, I think, is valuable, not so much for what I do. I mean, you can see my name on here. I'm just a dope with a MacBook. The community of people on my site that if you join, you get access to, that around the world. I mean, we got people from Croatia that share what they're seeing, share the links that they found. We're all in the same boat, adrift in this storm. And so I think the community of the site is what makes it most valuable. It's only $15 a month. So you can join us for a month. And if you don't think it's very valuable, what are you out? Lunch? But I think especially at this time, now we've made it through this year, I think I'm pretty proud of what we have there. And just tfmetalsreport.com. I'd encourage people to check it out.
Great. I'll put a link in the description below. It was awesome having you on, and look forward to speaking again in 2023 to continue the conversation.
It's going to be a crazy year, Jesse. It's always good. I'll be happy to visit with you anytime.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.